Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Justin Carbonell and Jack Forehand are principals at Volatility Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Volatility Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Volatility Capital or Sunpoint Investments.
All right, gentlemen, how are you? Today we're going to kind of get into back to factor investing a little bit and talk about the low volatility factor. And I think today's discussion will kind of start from the ground up. We'll talk about what low volatility is, some of the academic research behind the factor, why it might work from a risk and behavioral based perspective, and then get into some of the strategies that are on Validia, what goes into them, talk about maybe the pluses and minuses of low volatility investing, how it can be used in building multi-asset investment strategies. And then, Matt will sprinkle in, of course, how he thinks about low volatility and working with clients that he does planning for. And so let's just start with, if we were to try and define low volatility, how would we go about doing that? I think, a lot of investors might think like when they think about low volatility, they might think like, well, that might mean utility stocks or maybe large consumer staple stocks or stocks like that. But, it's not really done on a industry or sector basis. It's more done based on some measures around a stock's variability. So maybe Jack, why don't you take sort of walking us through what the definition actually is?
Yeah, well, this is like a perfect factor for me to do because, as you guys know, I'm a pretty boring guy, and as the viewers have probably learned as well. So I like to implement the principles of low volatility throughout my life. I'm not just doing this on the podcast or in my factor investing career. I'm trying to keep things down, keep things under control, and I'm also trying to get a better risk adjusted return while doing it in my life as well. So this works out really well for me. But yeah, in terms of the definition, it's the easiest factor to define, I think, because there's not that many ways to measure it, and it is what it says it is. It's low volatility. So, I'm investing in things that are less volatile. And, there's typically two ways to measure it that are primarily used. One is beta and one is standard deviation. And so standard deviation would be any asset, the volatility on its own. I don't consider anything else but the asset. Beta, I bring in covariance. So basically I'm bringing in like, how does this asset play into an overall portfolio rather than just how is it volatile on its own. So you can do it either way, and it's been shown in research to work either way. But the general idea is I'm just buying stuff that's not volatile. And, in theory, and we'll talk about this in a second, in theory, I should be getting a less return by doing that. But in reality, I'm not. So that's a basic introduction to it.
I think in those terms too, it's like whenever we talk about beta, we're ultimately just talking about slope and just understanding how steep is the pitch versus how like flat is the pitch relative to whatever else. When we're talking about variance, we're talking about volatility or standard deviation, how much stuff zooms up and down. I think about this a lot in terms of like min vol is basically the dentist office music of investment strategies. It's basically the stuff in design that should be the least offensive, the least jolt you out of the chair, the most singing fields of gold while they're drilling your molar, that you'll just be like, I can deal with this. I can accept this. And that's a wonderful thing. You could still have a chart topping smash hit. You can still have Hero by Mariah Carey. And yes, I do have a waiting room dentist office Spotify playlist that I found on the screen in front of me, which may ruin this entire podcast. But the idea is you could still have a hit song. You could still have something. You could still put a whole playlist together of stuff that's basically unoffensive, is there, gets the job done, and plows forward without rocking the boat too much.
Yeah, Matt, we were joking the other day. This is like the smooth jazz of investing to some degree. Like I was hoping you would do the smooth jazz DJ like for the whole episode and just, keep things nice and calm. But I mean, that's basically what this is.
But I would just be like ragging on Kenny G or whatever the whole time. And I realized like, that's not right when we have, like, there are smash hits. Like There are just so many smash hits. Here and Now, Luther Vandross, I Have Nothing, Whitney Houston. There are great dentist office songs. I'll admit this, and I won't just rag on smooth jazz. And I won't also take you down the other path that I woke up this morning thinking of, which was explaining the cool jazz moment of the post-World War II era and telling you about Lenny Tristano or something. So this is what you get. We're talking Celine Dion and Linda Ronstadt probably for the rest of this episode.
And just to put some numbers behind beta and standard deviation. So a beta, the market has a beta of 1. So if something has a beta of above 1, it tends to be looked at as riskier than the market. Below 1, less risky in general. And then on the standard deviation side, I think the S&P has like an annualized standard deviation of, I think it's something like 16%, give or take, somewhere in there. And so that's the type of variability you'll have around, any year return, within one standard deviation, it can be plus or minus 16%, the average return. When you start looking at specific stocks, especially from a standard deviation standpoint, they can vary significantly. I think there's something out there that shows that, your average stock may have like a 30 or 40%, move in any given year up or down based on what's happening. So just to kind of put some numbers behind those definitions for reference points. But let me ask you guys, why should investors really care about this?
Well, this is basically the holy grail of investing. I mean, like, what am I trying to do when I invest? I'm trying to get the best return I can, and I'm trying to do it with the least risk possible. So this basically plays into what is most important in investing. And if I can buy something that is less risky and I can get a better return or I can get the same return, then I have just created a much better portfolio than what I already had. And so that's why this is so important, I think, and why it's so appealing to investors, this idea. And also when behavior comes into that's really important too. Like, we know high volatility creates bad behavior. Lower volatility leads to better behavior. So when you put those two things together, this is a really important thing, I think, when you think about it in the way investors actually act in the real world.
The risk and return balance, especially when you're designing financial plans, when you're picking investments, however you fit this together, it's a lot like the speed limit too. It's like, we know, like, you drive too fast, you go Sammy Hagar, you hear, I can't drive 55 in that dentist chair, everybody's in for trouble. But this idea of, can I still get to the destination? Can I take the back roads and avoid the traffic jam on the highway? Or can I take the highway and avoid the headaches on the side streets? Like, these metaphors are all useful because what they're trying to do is say, how do I get to the return, to the destination, whatever, with the least amount of units of risk? And to talk about this quantitatively is to talk about, how do we define those units of risk? Are we pairing speed limit against Sammy Hagar and can't drive 55 and whatever very slow speed we assume Michael Bolton drives?
So, this idea isn't like original to us, obviously. This is a factor that's
We didn't just invent this right now?
No, yeah. Well, this is like on the fly.
I saw Matt's white paper before this, and I thought, like, this was us.
Matt tweeted his
I tweeted my white paper.
But let's we've talked in the past about what makes a factor, and there are really 5 different criteria. And we've had Larry Swedroe and Andrew Birkin on the podcast to talk about this. But let's just quickly walk through what those characteristics are in terms of making a factor something that, investors should believe in.
Yeah, and I would highly recommend that book, A Complete Guide to Factor Investing. It's really, really good. And it's written in a pretty accessible way. Like, some of the factor investing stuff can get a little bit too deep, but it's pretty accessible. So I think that's a great book to read. But yeah, to your question, the criteria they outline in that book are persistent, pervasive, robust, intuitive, and investable. And so let's go through each one individually as we think about this. And in this discussion, we're going to reference a lot of the work of Pim van Vliet. Like his paper he wrote with David Blitz, the volatility effect, lower risk without lower return. And he's got a lot of other papers that we'll talk about as well. But so we're going to use some of that as well as it relates to low volatility. But so what we want in a factor is we want it to be persistent, which means we want it to work over time. We don't want it just to work in 5 years or 10 years, or, we want to see a very long track record that it's worked. We want it to be pervasive in that we want it to work across different asset classes. And interestingly enough, and we won't get into this in detail, but this is the low volatility effect works in bonds as well. So you do see this working not just in stocks, but you see this working across asset classes. Robust meaning it holds up to different definitions. And we just talked about that. We talked about beta and we talked about standard deviation. So if you define this one way and it works, and you define it in a very similar way and it stops working, then I have to question, whether this works. Intuitive, which is, we've kind of had some podcast episodes calling this into a question a little bit, but the idea is these things should make sense. There should be some reason why it works. And this is probably, and we'll get into that later, this is probably the hardest factor to explain from an intuitive standpoint, because just think at a high level, like, I'm taking less risk. Why should I get a better or the same return? Like, that doesn't make any sense. And we can explain later why it does make a little bit more sense than you think. But so a factor should be intuitive. And I think this does meet that definition. It's just a little bit more indirect than some of the other ones. And investable. I should be able to buy it. It should be something I can invest in. It should be something that I am not like impacting dramatically while I invest in it. So if this only exists in like $1 million market cap companies, then I can't really do a lot about that as an investment manager, because in buying them, I'm going to basically get rid of any of the positive things that are going on. But so this meets all of those definitions. If you look at Swedroe and Birkin's criteria, the low volatility factor meets all.
Yeah, so that's good. Those are important things when you're thinking about what makes a factor a factor. Those characteristics and qualities. Talk about a little bit. I know in doing some work for this, you were able to pull some of the risk and return data of low volatility stocks versus the market. So just talk to those numbers a little bit to put it in some context here.
Yeah, it's interesting. So you look at basically what they do in these papers a lot of times is they break things into deciles. So 10%, like take 10% of stocks ranked using the factor and look at and typically they'll look at the top decile and the lowest decile. And so the top decile, which they call D1 of the least volatile stocks, is only about 2/3 of the volatility of the market. And it has a 0.72 Sharpe ratio versus a 0.4 Sharpe ratio for the market. So what is that telling us? That's basically telling us I'm getting a much better risk-adjusted return by investing in that top decile of low volatility stocks than I am by investing in the market or investing in the other deciles. And so that's kind of the holy grail of investing in some ways, because if I'm getting a better return, I'm getting a better or I'm getting at least the same return, if not better, I'm getting a better risk-adjusted return. Like, it would be a no-brainer for me to invest in those types of stocks versus something like the market portfolio. And also, by the way, just to look at the other side of it, like the other part of this, the worst decile has just terrible metrics on everything you could judge. It has worse performance than the market. It has much higher volatility than the market. Unless you're like the ultimate contrarian who thinks like everything of investing is going to flip in the future, and basically my goal is going to be to get the highest volatility with the lowest return, you probably want to be avoiding that part of it.
I think this is really important, and I think this is something that I struggled to understand way early on in my career and getting drawn to this stuff. The top decile versus the bottom, and then the value of like the long short portfolio composition to prove this out.
Right.
Just comment on why we do that.
Yeah. So, and that's kind of separates this from the real world to some degree, because your standard factor ETFs are not doing it this way. But when you want to test a factor, you want to find out, do the best stocks outperform in the way I want them to? And also, do the worst stocks underperform? Because if only the best stocks outperform, and then as you move down the deciles, you don't really see any evidence one way or the other of anything, it's not as strong of a factor. You want things that are bad with the factor to do poorly. And so that's what they did with low volatility, and it works. And what's interesting is in some factors, you'll see like one of those dominate. So basically what I do is I'm long the top decile and I'm short the bottom decile. In some factors, you'll see that like the long or the short side dominate. So you'll see like most of my returns are from the long side. And where this is important for your average investor is you don't want to see the ones where most of the return is from the short side, because in the real world, I'm investing in the long side. But in this case, they're both good. You're getting a better risk-adjusted return from that top decile, and you're getting basically terrible performance with high volatility out of that bottom decile. And so the academic research backs up this factor when you think about it in a long-short framework.
Probably one of the most interesting parts about this, and this is beyond low vol, but this understanding of what you just laid out. It's not just the persistent, pervasive, robust, intuitive, investable piece in that top decile. It's, can we basically see the opposite also playing out and then map it against these two things? So we take the whole S&P 500, we chop it up into the deciles, and we look at top versus bottom, and we look for that long short proving and say, can I prove it also on the long side? And then that's kind of like a long walk to get to building a mutual fund or an ETF out of this thing, I've always thought.
Yeah, no, it is. And it's academics look at this stuff very differently than we kind of do in the real world. Like academics want this stuff to stand up. That they're looking at T statistics and all this stuff. They want to really prove that this is solid. And they do that in a lot of different ways to try to prove that it's solid. And then those of us in the real world take that and say, all right, here's how I manage a portfolio in the real world. Well, I'm not going to, my average ETF is not going to be out here shorting stocks. And most people want, when you're running a long only portfolio, you're also getting exposure to the market going up over time. You're getting exposure to the beta of the market. Most people want that exposure. So a lot of people would prefer not to have, the long short low volatility ETF versus the long only. So in the real world, we have to think about what are we trying to accomplish? We're trying to benefit when the market goes up over time, but we're also trying to find factors that give us a bit better risk adjusted return. So we take that academic research and we spin it around and we say, all right, we only want, we're only going to use the long side of this. But we also have to keep in mind, like I said before, that if it mostly works on the short side, then I may not be getting the benefit, I think, of using the factor.
Yeah, it's so interesting because when we approach it academically, and I'm thinking of, I know this is in the Daniel Kahneman episode we just recorded too, but the exposure to noise and correlation and the reality of like causal bias when we're looking at this stuff too. And understanding when you're building products or you're building investment strategies around this stuff, the academic theory gets you up to a point and you have to understand that, but then you can step away from it. It's in the truest sense of the word. This is like how like Boys to Men isn't just slow jams. You got Motown Philly and I'll Make Love to You side by side with each other. It's really interesting. Like there's no long short portfolio that proves out why those things can't exist. In the real world, those anomalies can exist. In academic factor land, this is the way we think through it and try to then go and test these strategies in the real world.
Yeah. And it's also important to think in the real world, both from the perspective of like, how is things different than the academic research? Like academics do try to account for transaction costs and stuff, but it's
Right.
hard to do. I mean, that can be a little bit different in the real world. And also going forward, we have to understand, and this is something that's come up a lot with Fama French's work, like once this stuff is out in the public and it's available in the real world, and a lot of people start to follow it, it might not do as well. And so you can't keep referencing the academic research from 20 years ago if it shows that in the real world, everybody's followed this academic research and it's not working anymore. So there's this transition from the academic research. We always have to take it, we know the academic research is typically done well, but that doesn't mean that it's going to work for the next 50 years, no matter what. I mean, we have to look at it in the real world and see what evidence we're seeing post the academic research and also what was in it and say, like, does this make sense in light of what I know today?
Yeah. And what's changed, right? Like that's the reality of it is different things change. Different things come in and out of flavor in markets, in realities and whatever else. So these things, we hope they're enduring and pervasive in all the ways that we're describing. But the reality is stuff like it's not. Just look at any stock market index over time and consider the ways these companies have inevitably changed.
And just reading your white paper this morning, I've already adjusted my investment strategy. So, I mean, this is how quickly the academic research can come out and change things.
Exactly. And how durable it's translated to crypto markets as well.
So one of the things with all of these factors is we like to try to think about them through both the risk-based explanation as to why they work and then the behavioral-based explanation. And I think some factors, at least to me, are a little bit easier when you're trying to look at them through that framework. They're easier to explain in terms of how they would fit into either of those buckets. But with low vol, obviously the risk-based, you can't really make, well, I mean, maybe there is, but we'll talk about it. But the behavioral tend to be a little bit more clear to me. And there's really three different sort of behavioral reasons or arguments as to why low volatility works. I don't know if either of you guys want to comment on the risk-based thing, and then we can kind of work into the behavioral points.
Yeah, if you define risk in a standard way, this doesn't make sense because obviously the way we're defining risk is actually what this factor is all about. So we're defining this, we're defining risk as beta or standard deviation, and we're investing in low standard deviation stocks. So how are we going to make a risk-based argument that this should work? It doesn't exist. But there are behavioral arguments. And the idea, a lot of it is like investors seeking out better returns by doing a bunch of things. So
wait, hold on. I do have to say, the risk-based argument for this thing is back to the analogy on like speed, like, and driving speed. So extra Sammy Hagar. Like if I get in my Justin, you tell me, what car do you think Sammy Hagar was driving in the I Can't Drive 55 video?
Probably like a Mustang or something.
Must have been like a Mustang or like a Lambo.
I figured you would know this, Matt. You don't know this? This is like the type of thing you always know.
I left this out of my white paper, but it's the idea of theoretically a risk-based model of like low variance basically says like, can Sammy Hagar jump in his Mustang and drive as fast as possible on whatever substances he may or may not be on to the location and get there? And the reality is like, yeah. If you go super, super fast, you can get there faster. The problem is that opens you up to getting pulled over, getting through a difficult scenario of lamenting to the police officer, you just can't drive 55, all these things, which means like the grandma cruising along at like 40 miles an hour or whatever is still might beat him to the destination. The risk-based explanation includes a tortoise and the hare reality of trying to get from A to B. And it's useful, at least to me, to help remember that. Sometimes the fastest way is not the best way. Sometimes the slow and steady way actually beats the fastest way because the fast gets mucked up.
Don't know how this is related to this, but my wife actually got pulled over for going 40 once on the highway. She's not the strongest driver, and like she was just cruising along at 40 in the right lane, and like the cop pulled her over, like, "What are you doing? Why are you going this slowly?"
The min-vol speed limit there.
Right,
she reversed Sammy Hagar's situation.
She was adopting like a min-vol strategy in terms of her driving on the highway.
It was a 1984 Ferrari GTO, by the way.
It was a GTO. Look at that.
Yeah.
So anyway, back to what I was
so the
explaining.
behavioral side of this thing.
Right, yeah, exactly. So it comes back to the idea that people are typically trying to generate better returns in a variety of ways. And, so for instance, if investors can't use leverage, if you assume there's limitations on using leverage, then one way I might want to get better returns is by investing in high volatility stocks. That overprices the high volatility stocks. I know, Matt, you're a big person seeking out the lottery stocks, the call options and all that kind of stuff. A lot of people like you doing that kind of stuff, driving up the lottery stocks, unfairly. So you've got an opportunity when those stocks are driven up unfairly. You've got a nice, opportunity in the lower volatility stocks, investor overconfidence, same type of thing. So yeah, a lot of those behavioral explanations work a lot better than the risk-based explanation. But there is some interesting, and we'll get into it in a second, there is some interesting research from Cliff Asness and a bunch of people whose names I can't pronounce that I would embarrass myself if I attempted to, that like it sort of tried to break this thing down and look at why it works, which I think is interesting.
Utterly fascinating to think about why this can work and why it can exist outside of those crazy examples. I'm really curious. What are the behavioral pieces from the Asness piece?
So
I'm not sure if I know this paper. Is this an old paper?
Yeah, 2017, okay. Which actually in terms of the academic research is a fairly new paper, but it's not that recent. Because there aren't too many people writing about this like on a yearly basis with like groundbreaking papers. But anyway, the paper is called Betting Against Correlation, Testing Theories of the Low Risk Effect. And I'll just read. If the low risk effect is driven by leverage constraints, risk should be measured using systemic risk, beta. On the other hand, if a low risk effect is driven by behavioral effects, then risk should be measured using idiosyncratic risk, volatility. Stocks with low idiosyncratic risk outperform stocks with high idiosyncratic risk. That's what they're explaining the thing. So what they're trying to do is they basically made two, and I'll read another thing in a second. They basically broke the factor in two and looked at it individually and said, like, does it hold up in both cases? And I'll read just one more part from it. The challenge with the existing literature is that it seeks to run a horse race between factors that are by construction highly correlated, since risky stocks are usually risky in many ways. Hence, the most powerful way to credibly distinguish these theories is to construct a new factor that captures one theory while at the same being relatively unrelated to factors capturing the alternative theory. To accomplish this, we just decompose BAB, which is just a low volatility factor, into two factors: betting against correlation, BAC, and betting against volatility, BAV. BAC goes long stocks that have low correlation to the market is short, and shorts those with high correlation, while seeking to match the volatility of the stocks that are bought and sold. So basically what they're doing is trying to isolate them while holding the other thing constant. And what they find, to summarize it briefly, is they both work. So there is an explanation kind of on both sides of things. Both factors hold up when tested individually, and I think look pretty similar to each other. So that would kind of say like there are multiple explanations going on here that can be used to explain why this works.
And it's interesting because this evolves over time in that sense too. So like different companies with different levels of perceived idiosyncratic risk at different points of time are going to pull and push further and further away and closer to the underlying benchmark. Like, is that another piece to take out of this?
I think the way the leverage is important on a company specific level. So that makes a lot of sense. So over time, a company, different types of companies in their life cycles rely more or less on outside financing. And so that's an important, I think, thing here just to recognize. I mean, I was kind of thinking as we were talking about this, and maybe I'm going off a little bit, but if you think about at the end of 2001, and I think this is a good example to try to think about what was going on in the market. So you had, all these unprofitable growth stocks that, pretty much were relying on outside. Well, they weren't profitable. They weren't generating cash flow. And you had, all that sort of speculation and risk in the market. And then that all kind of came apart in 2002. And that's sort of a good example, I think, of like the behavioral side of why low volatility might work in some instances, because, to Jack, your point earlier with investors kind of looking for these lottery stocks and, sort of investing in these types of like higher risk companies, which those companies were higher risk in both cases. They were higher risk because the fundamental quality of a lot of those businesses just wasn't good. And also they were higher volatility because, investors were, in a lot of cases, chasing those types of stocks, and they were more probably volatile just overall from a beta perspective. And then that all obviously came crashing down in 2022. And I think, I don't have the numbers in front of me, but I think like low volatility stocks that weren't really participating, that didn't require as much like outside potential financing, those are the types of stocks that held up better in what was, that bear market. So just trying to put like some context with something that we've been through recently as investors and trying to think about it from this risk standpoint.
Yeah. And even in like the last few years before it all kind of fell apart, like if you think of the Carvanas of the world, like when you're seeing like the massive hundreds of a percent return in that, people do tend to chase that type of thing. You tend to want to put your money in that and be like, oh, everybody else is getting these hundreds of percent of return. I want to get that too. Like you put your money in it. And so systematically, those stocks end up getting overpriced relative to where they should be. And, that might be the person who's just sitting there with their low vol portfolio is not participating in that. But over time, they're going to probably win the race against those types of things. And again, going back to the academic long short framework, shorting those companies that, have the highest volatility, tends to be a good bet. Although you can get, trying to do that in the real world, which is something we didn't talk about, Matt, when we talked about the long short thing, is like, it's great to look at these factors and be like, oh, the long short portfolio does really well over time. Like you're going to destroy yourself at different points with that. Like think about being long, low volatility stocks and short the Carvana type stuff, like in 19 or 2020 or 21, like, or maybe not 21, because I think it turned then, but like some of those periods, you would just be, if you don't manage your risk properly and you don't size it properly and everything, you're going to be completely ripped to shreds, because when you do long short, it can go against you on both sides. So not something your average investor has to worry about because they're not investing that way, but it is like, it's easy to look at these long short returns in an academic paper and look at them over, 50 years or something to be like, oh yeah, that sounds great. You get outperformance that way. But when you look at it in the real world, like you probably would have blown up a couple of times along the way too.
Now, I want to make sure I have my timing right, just for clarification standpoint. So was the big run up in growth was that 2020 or was that
2020? Yeah. I mean, I think it ended
2020. Okay.
I think like the arcs of the world peaked in early 21 is what I believe.
Okay. So I was off a year, but anyways, the point's still valid, I think.
But within that, I think that's part of what makes like the Cliff Asness paper so interesting here, because we can take the academic realities of the long short portfolio and why that is hard to do in reality, but we can still look at some of the stuff. And that, I think that gets to the heart of the theory behind betting against correlation and betting against volatility. So on the long side of these things, like being long stocks that have low correlation to the market, and also being long stocks that have low volatility relative to the market, and looking at this subset of stuff that just says like, simmer down for me, all you low vol, you're coming back to me now.
What's also interesting, just going back to that long short thing, is like you have to, like in the real world, you end up having to like beta neutralize these things, because think about it, like if I'm basically short high volatility, high beta stocks and I'm long low volatility stocks, what am I also? I'm effectively short the market as well. And so like you have to be that can blow up on you in like very, very bad ways at different times. So like people will actually neutralize a lot of this stuff to neutralize some of the other stuff out of there and try to get your core exposure to what you're actually trying to be long and what you're trying to actually be short.
I think we're going to look at some ETFs here in a minute that incorporate low volatility. But one of the, I think, interesting things here is that, oftentimes this is coupled with other factors. So, you might, and to some extent, like I talked about at the beginning, like low volatility stocks tend to, they aren't always from a specific sector or area of the market, but you do tend to find them, the types of stocks you would think you would find in a low volatility portfolio are kind of what you get. But a lot of times it's coupled with other strategies or other fundamental criteria like value or quality and things like that. It's just not buying like low volatility stocks only. There's often other factors that are basically being incorporated in there. And like our model that we run, one of the interesting things that I think with our Pim Van Vliet model, which we base on his book, what's the conservative stocks
formula?
Yeah, conservative. Yeah. So I believe this is true. Jack, you might not have it right up in front of you, but I don't think he's using anything off of the financial statements. I don't believe. I believe his whole deal is that this is like everything that he's using is actually just either price-based or I know shareholder yield is in there, but I think you can kind of get at that. He made the point before that it's, you don't have to dig into these financial statements to run this strategy. It's a pretty simple, straightforward strategy. But I think for that one, there is no quality. Well, I guess, no, is it net buyback yield or is it shareholder yield?
Yeah. So it's the criteria are market cap, standard deviation, 12-1 momentum, net payout yield, and then a rank. So yeah, so I mean, it's using the balance sheet in that it's using net payout yield. But, it's basically gets at this idea. First I want to go back to that other thing you talked about because it's so important is the fact that this is not always the same sectors. I mean, in the short term, it can tend to be the same sectors. Like if you looked at it right now, your consumer staples and, those types of things are in there. But if you look at it over time, it can be different than that. So I remember we had a guest on, I forget it was Pim or someone else, but who talked about like back in the day, I think it was like energy was in like the low volatility basket a lot.
Right.
Now you would never find, you're not going to find energy in a low volatility basket. And what's also interesting is as the Facebooks and the Microsoft mature, you're probably not there yet, but those, as they become proven companies, you're probably going to start to see them in the low volatility basket. And they are basically tech companies or, I don't know what they're classified as now. Some of them are in different sectors, but they generally are tech companies. So companies you never would have thought would have been in there years ago. So it's pretty consistent, I think, in the short term in terms of the sector allocations, but it can change a lot as the world changes and the economy changes over time.
Which goes right back to why those 5 factors are so important as we break these things down. Because the tech companies mature, to your point, into stuff that might not be the sexy, fast driving, far market beating things. And they turn into more boring businesses over time. Like, we're still a ways off probably from Amazon being our grocery store and mall. But at the same time, it's like, we're converging on something that's adding all these new things and features to it to something that's much more recognizable as a conglomerate of things of yesterday. And that's really interesting. Also totally amazed by, I know we'll talk about inside of some of the ETFs and strategies, but like I distinctly remember when I think it was like the utility sector was like 60% of one of the min-vol strategies. And there was a bunch of people who are like, maybe not exactly betting against, but it's a sector that's historically like sub 5% of the S&P 500. That's all of a sudden 50% of a strategy. And at some point, how does this crack on the rebalance into the flows matter? And that's always interesting.
To that point too, like, so yeah, you're in a low vol strategy, it's 60% utilities and then rates rise. And why do people buy utilities? They buy utilities because of the dividend payments. Well, when rates are increasing or where they are now, if you can get a 5% yield risk free, you're going to take that and you're buying a utility with like a 5% yield. And that's really why you're buying it. You can see how at different market regimes and different things that are happening, how those low volatility stocks could actually turn into maybe high volatility stocks to some extent.
Yeah. It's kind of like, it's the when friendly looking pets attack of like, or whatever, right? Because
I love those.
when the low vol becomes the high vol thing. And that can happen here too, which is important to acknowledge.
That idea of like the risks sitting beneath the surface that we haven't seen in a long time is such an important one to think about. Like, I mean, the example people give now a lot is the idea of stocks and bonds. Stocks and bonds, you don't need anything else in your portfolio because you didn't need anything else for 40 years. But to your point about utilities, the same type of thing could exist. Like if somebody's running a low volatility strategy and they don't have constraints around something like utilities, and then something happens that hasn't happened in 30 or 40 years, you might see it not being a low volatility strategy, even though you thought it was a low volatility strategy. And we'll get into the factor tool in a second, which will help us kind of look at some of this stuff. But that's an important thing to keep in mind. And also to go back to your question, which I again went on my tangent, which got away from this idea of using low volatility with other factors. Like, it's a great factor to do that with. It works. And, when we listed with the Pim van Vliet strategy, he was using net payout yield and momentum with it, but it works really great. And net payout yield is kind of a value thing. It works great with value. It works great with momentum. Quality, it tends to be somewhat similar. I mean, it still can work okay with quality, but it tends to be a little bit similar because quality companies tend to be lower volatility, but it's a great factor in that it's very flexible like that. You can couple it with the other factors and you can kind of get a lot of benefit from doing that. So this is one of the biggest minimum volatility ETFs. And we didn't do this earlier, but we should have defined the difference between minimum volatility and low volatility. So low volatility is really more about the individual assets. So when I'm running a low volatility strategy, I'm looking at the volatility, whether it be the beta or the standard deviation of the individual assets, the stocks, and I'm putting them together. I'm not really thinking in a portfolio context. When I'm doing minimum volatility, I'm thinking in a portfolio context. I'm trying to minimize the overall portfolio volatility. So I actually can add higher volatility assets to my portfolio if they reduce the volatility of the portfolio as a whole, if they are like very uncorrelated. So it's just, you'll see both of them out there in the real world. So it's important to distinguish those two because it's a nuance behind the scenes that sort of gets at how they're constructing the portfolio. And this is actually the biggest minimum/low volatility ETF out there, which is USMV. So we can look at, I'm just interested to look at, I want to look at some of the factor profile here as we scroll down. And, the first thing you look at is like low volatility. You've got a very, very high score here. So even though this is minimum volatility versus low volatility, you're seeing this is definitely investing in, low volatility stocks that score very highly with our low volatility factor. And the other thing that I think is important that we talked about before is this correlation with quality. So you've got a quality score of 86 here. You've got a very high quality portfolio because, again, low volatility stocks tend to be high quality companies. Carvana is probably not going to show up in your low volatility screen. So there's a correlation between those two metrics. And the other thing I would point out is just over time on the other factors, value and momentum, just like momentum is a chameleon, low volatility to some degree can be a chameleon as well. There was a point, and I don't know what it was, like a few years ago or maybe a little bit more than that, where low volatility stocks just were the rage of everything and they got really, really expensive. So they had very low exposure to value. And then there's times where they're out of favor, where they might have high exposure to value. And the same thing with momentum. If low volatility is doing well as a factor, you'll have high momentum exposure. It just all depends on kind of what's going on in the market at any given time. So quality and low volatility tend to be high in unison a lot, but the other stuff can vary a lot depending on what's going on. And the only other thing I'd mention on this is just going down to that sector exposure thing. This gets at what Justin was talking about before. This is a good way to look at some of these just to see, this one is pretty balanced. Like, it's not that, based on our sector definitions at least, it's not that different than the market. There's not huge bets, and it's a pretty diversified ETF, so it shouldn't be. But this is where you would see what Justin was talking about before. Like, if this thing was all utilities or something, you'd see a huge, excess exposure relative to the market of utilities. So it's just a quick way to look and see, like, if what I'm getting is fairly similar to the market in terms of the sector exposure, or if it's really, really different.
So just from a performance perspective too, when you, so in 2022, the market was down about almost 20%. This fund was down 9.4%. So certainly held up better in 2022. But then on the flip side, in 2023, when the S&P was up, 26.8%, this fund was up 10.3%. Year to date, it's up 7.5% versus about 10% for, I think, the market, if I have the quarterly numbers correct. So it's kind of a interesting, that is from an investor standpoint, certainly. And we know that, a lot of times investors make mistakes when the performance is bad. A 10% loss is, tolerable by a lot of investors. But then, the downside of it is when the market rips and you have all those growth stocks coming back, which is what you had last year, this fund trailed by 16%. And so if you're the type of investor that's, sort of the fear of missing out, and that would be sort of maybe the flip side of where, the other downside to it,
So
which is it's not going to keep up with the market when it rips like
yeah,
that.
if you look at like O'Shaughnessy's 2 points of failure for investors, you're kind of trading one for the other with this to some degree.
Right.
With these,
Right.
you're saying basically, all right, I want less losses. So you're minimizing losses, but you're maximizing the other one, which is I can have those periods where the market's ripping and I'm underperforming. And so it depends on we've been working with a lot of investors. We've kind of learned every investor looks at that kind of stuff differently. Some investors are more averse to losses. Some investors are more averse to like, I can't underperform the market. I'm judging, people at the cocktail party. So it's just important to think about that trade-off when you invest in this kind of stuff, because you are getting less volatility, you are getting less downside, but you also are going to have those years where the market rips and you just trail by a lot.
Now let's do this. Let's switch it to SPLV, which is and then I want to do one other thing, which is the Invesco S&P 500 low volatility. So this looks like they're taking the 100 stocks in the S&P 500 with the lowest amount of volatility.
Yeah, so this is, as opposed to the min-vol one we looked at last time, which was looking at it more in a portfolio context, this is a low-vol ETF. So this is looking more at the individual assets. And like you said, this is a large cap, low volatility ETF. And as it turns out, you'll find like a lot of the low volatility companies in the large cap space anyway. You won't find that as many of them in the small cap. So it's not that big of a difference here. But yeah, so you'll see like this has 100% active share versus the Russell 2000, meaning that it's obviously all large cap companies. So yeah,
Okay.
moving down to the factors, we'll see kind of a similar picture to what we saw with the other one. In this case, instead of I think 97, it's 99 on low volatility. But again, you're seeing high exposure to quality because you typically will always see that with these low volatility ETFs, and you're kind of seeing similar things on the value and momentum side as well. These stocks haven't done as well recently, so the momentum is a little bit lower. We've been having a big market run, like we talked about before. When you're having a big market run, sometimes these things are trailing, so that they don't have as high momentum. But you're seeing a lot of the same stuff you saw before, and then you are seeing a little bit bigger sector bets on this one than you did on the other one. So you've got some of these. You are seeing a bigger utility bet, like you referenced before, Justin, like 12% ahead of the S&P 500 in terms of its weight to utilities, and way underweight technology. So yeah, again, it gets into the details are always really important in this stuff, and you can look at how the exposure to factors, but you can also look at like what they're doing on the sector side. And you can learn a lot about how they're constructing the portfolio and what the end result looks like.
So what's interesting is, the MSCI USA min volatility is benchmarked to the large blend index, whereas this ETF is benchmarked to the large value. Interestingly, because its current value exposure, at least through our thing, is not really, high on value.
Is that that's from Morningstar?
Yeah, this is from Morningstar. And the reason that I'm interested in that is because just again, from when we look at the return profile of this specific fund to compare it, in 2022, this fund was down only 4.8%, but it has the index only down 6.9%. And then in 2023, this was up 0.5% versus the index, the large value Morningstar index of 14.3%. So, very different return profile when you look at those kind of 2 years versus the first one we looked at.
Thankfully, Justin, as opposed to Morningstar, like Validia has a very, very talented programmer who makes their categorization of this. So we have both categorized as large cap, low volatility. So my extensive system that looked at the holdings behind the scenes and classifies them based on their holdings is it looks like has actually properly classified these two.
Now, one of the things that you can do here, by the way, is you can compare. So we can say, let's compare SPLV versus, and you can see, then we start comparing the differences in the factor exposures, which, that's kind of very useful. So you kind of know what you're getting, right? Like if you're looking at two ETFs and you're like, I want to seek the most low volatility or the most value, and you're being presented with two different options, this comparison feature is pretty useful.
Yeah, what's cool too is you can see the difference. You see below the difference in the sector allocations too. You can kind of see what one has in terms of its sector allocation relative to the other. So if you're comparing the two and I'm looking at buying one or the other, I can see like what I'm getting from a sector perspective in both of them. And the factor things you talked about
Right.
before
So
are
this
pretty
is basically saying
go ahead.
that its largest overweights in SPLV versus USMV is, consumer non-cyclicals, utilities, and then capital goods. And the biggest underweight, right, is technology.
Right, which is what we showed before. So the chart we looked at before was comparing it to the S&P 500. Now this is comparing them to each other. So,
Right.
SPLV had a significant underweight relative to the S&P 500. It also has a significant, underweight of technology relative to USMV. So it's just an interesting way. I mean, it's not that you have to draw any conclusions from this, but it's just an interesting way to understand what you're getting when you look behind the scenes of this stuff.
Well, you have two different recipes to get to the end result, right? They both have a different thing they're aiming for, but two different ways of building it from the bottom up or the top down. And it's really interesting to think about how, again, back to that initial idea, both of these things actually work in practice. They've both been proven out to do what they're supposed to do, but they're solving it from two very different ways, as the tool suggests.
We're kind of getting towards the end here, but do we want to talk about, I know we're all sort of fans of Nomadic Samuel. He's pretty widely followed on Twitter. He has a site, Picture Perfect Portfolios, I think it is. And
Yes.
he, he writes about different investment strategies, managers contribute and explain their strategies on that site. But one of the things that he does a lot of work on is he's building and testing of multi-asset portfolios and sort of trying to get at portfolios that are very robust and that work over all different, almost like all weather, and work over all different market environments. I think we had a couple of thoughts on the importance of, how he's incorporating low volatility in those multi-asset portfolios and what some of his research is finding.
Yeah, well, first of all, I would definitely endorse, Picture Perfect Portfolios is a great site. And, what he does a lot of different things there, but one of the things he tries to do is build these optimal portfolios from a risk-adjusted return standpoint, and also build optimal portfolios in terms of minimizing drawdowns. So, because that's sort of the holy grail of investing for a lot of people is if I want to build like a consistent portfolio that minimizes drawdowns, how do I do that? And, the answer to that at a high level is a lot of, a multi-asset portfolio that takes into account things other than stocks and bonds. And there's so many tools, we've talked about what Corey Hofstein's doing with the return stacking stuff. There's so much stuff that's available today that wasn't available in the past. And so there's so many ways you can construct these portfolios, like thoughtful ways of combining all these ETFs together into optimal portfolios. And he does tons of it there. There's tons of different ways he looks at that. But one of the interesting things that I've kind of learned from looking at his stuff is when you look at trying to build a portfolio that minimizes volatility, that minimizes drawdowns, a lot of people will look at like all these other asset classes and like, let's take my stocks and let's put all these other asset classes in here. But it's also important to pay attention to what's actually going on in the stock sleeve of that. And that's what he uses. He uses these types of things. Like I think he uses USMV a decent amount. He uses it there because if you're trying to build a portfolio to minimize drawdowns, like don't just look at all these other asset classes, but also look at minimizing drawdowns in stocks, and using minimum volatility or low volatility can help you do that. And so I think that's a thoughtful way he took something like this. So for an investor who cares a lot about this, for an investor who's really trying to minimize like the drawdowns of their portfolio and still get a decent return over time, these can be a great tool to incorporate into a multi-asset portfolio.
This multi-asset piece of this is huge too, because how to think about this cross asset classes, how to think about how it applies, and then how to space that out depending on what you need the portfolio to do. There's lots of advantages in understanding these variables so you can dial that risk exposure up and down.
Matt, talk a little bit about how you kind of approach this from planning sort of perspective, and do you incorporate any of these types of strategies in your client portfolios? I mean, I could certainly I think to me, it seems like these are I'm going to steal from Nomadic here, but picture perfect sort of strategies for sort of retirees, like people that need to make their money grow, but they don't want to get blown up. They're not really, when you're in retirement, hopefully you're not really trying to beat the S&P year in and year out, like you guys do. It's just, are you meeting your goals? Are you on track? Like the stuff that, that you advise clients day in and day out. But how do you and your team think about these types of, lower volatility strategies, and do you incorporate them or how do you guys look at it?
So we do incorporate them, thinking about correlations and overall contribution to volatility. when we're building portfolios is a big part of it. I'll say 2 places this type of stuff shows up, and I'll give you the very financial example, and then I'll give you the more planning oriented example. And the purely like financial example, it's all the risk tolerance type questions you just had. How risk averse are you? At what phase of life are you in? The big difference between, like, I'm thinking of like Eric Clapton, like when he does the Unplugged album versus, I don't know, Cream or whatever. Like there's just different phases of life where different things are more appealing. And knowing there are tools and methods to say, you don't need to hit as high on the upside. You just need to reduce that downside. You might be at a point in life where you need to tears in heaven it, and that's okay. You can do that. And that's useful. That's useful for us to know about a client across the table from us to build that thing for them. The more advanced version of that looks like too, clients who come to us who are aware of some of these quantity strategies and thinking about this stuff. It might also look like a very real conversation from just in the last week where somebody understands some of this stuff. We're getting towards that pre-retirement phase, which is a really important one, where the window of retirement is about to open up. Markets keep surging. It might happen sooner. Markets take a dive. They might work a little bit later. But as we're building the after-tax portfolio, so the taxable savings that are still invested, stuff like low vol can make a lot of sense. Because it might be, well, what if I lose my job, need access to this money and whatever else in this window of time? And that can guide some of those decisions to just say, how can I stay invested, but just with less downside risk? I'm okay with less upside risk, but I really need less downside risk to get through this next chapter in my life. And that might shift again. I actually had a meeting already this morning with somebody else who's older, but there's some Roth assets that are definitely going to the kids that we're not taking distributions from. And despite the age, it's like, yeah, let's go make money with this. Press the risk all the way down. Let's see where it goes. On the financial planning side, these ideas really represent how to think about stuff where you're willing to accept upside or you're willing to mitigate your downside. So something I learned from when I used to be at Merrill, from Savita Subramanian, from Nigel Tupper, from some of the people in that department was think about variance, think about volatility, think about betas everywhere. So you can look at your job, you can look at your spending patterns, you could look at your debt, and you could say, where are the places I'm willing to accept volatility and where are the places I'm looking to minimize it? And you could think about that from the top down. So I could think about it from the approach of the min vol, where I'm thinking about it, how it aggregates, or other people are wired to think about it from the bottom up, each individual holding. How do I have the minimum amount of volatility or variance across all these parts of my life? Understanding how you're wired, how you're aggregating that together inside of your plan, and what those choke points might look like. This is intensely useful logic. And that's part of why I love having these conversations. Because like low vol in itself, that maps over so many strategies for how we think about real life, and way more so in a way than how we think about stuff like momentum so often.
So I'm going to put you on the spot here. So which one of these 5 songs best embodies the concept of low volatility? Ready?
Oh, this is good. This is good.
Okay. Take It Easy from the Eagles. Don't Worry, Be Happy. With or Without You. The Waiting by Tom Petty, or Everybody Wants to Rule the World by Tears and Fears. Tears for Fears.
Wait, what was the first one again?
Take It Easy.
Man. So Take It Easy. You have the whole like hell freezes over thing, the eagle skull. And I mean, fantastic song. Take It Easy. Originally Jackson Brown, I think.
I might have
confirm
been,
this.
or he might have at least written it.
I'm pretty sure he wrote it. I'm pretty sure that's his song.
Yeah.
So that's definitely scoring high. I think Bob Marley is a sleeper. Bob Marley is not what I want to hear in the dentist chair. Let's just say there's other implications of substances that make me perhaps worried about the person doing the procedure. I'm in that camp. Maybe that dates me.
I think that might have been Bobby McFerrin. Actually.
Bobby McFerrin?
Yeah, it was Bobby McFerrin.
Don't worry.
Don't worry. You're talking about Don't Worry, Be Happy.
Oh,
yeah.
we stumped the.
You did.
You
know what?
This is like Ken Jennings on Jeopardy getting a question wrong. It doesn't happen.
Bobby McFerrin. I do love that song. I love that video. That's a weird one to hear in the dentist's office. I had Bob Marley on my mind because I saw like Three Little Birds and something else on this playlist.
Okay.
And I was like, if my friggin' dentist is stoned and drilling me, I'm not going to feel good about this situation. And what was the last one on your list too?
So the last few were, sorry, I keep on.
Like, it's definitely not Tom Petty. Tom Petty and that whole, like, I can't remember if that was Full Moon Fever or which cassette tape I had that on. Great variation inside of Tom Petty's music. Same thing with the Eagles. That's a hard one. Who was the last one on that list? Bobby McFerrin. I mean, wonderful. Thinking About Your Body live, one of my favorites.
Everybody Wants to Rule the World. Tears for
Fears.
I don't know. That wasn't a great one. Wasn't a great one.
I assume this is ChatGPT, Justin. You're asking it like for
this
low
is
volatility
this
songs
is
or something.
This is right. This is real time ChatGPT. But you know, hey, it's.
I mean, I gotta say, like, it's somewhere between. It's probably like Michael Bolton, because even like Celine Dion gets too chest pounding glorious in too many places. Like Michael Bolton might be the ultimate low vol strategy where it never gets carried away. It's a luscious perm that never devolves into Nickelback. You got the sax solos. I think there's a couple Kenny G partnerships. Like Michael Bolton feels like he embodies it in a way. Like Genesis got too lively. Phil Collins would get too dancey. Like Michael Bolton is in that lane. If I'm investing my funds in the ultimate low or min vol dentist seat chair, give me the Michael Bolton playlist and I have no fears.
And a low volatility strategy could also be your sole provider, Matt. It fits in that way too, right?
That's amazing. That is amazing.
Yeah. All right, guys. Good stuff. Thank you everyone for listening, and we'll see you next time. Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbino, and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.